Good morning and welcome to our webinar. Today we're going to be considering the recent study by the Competition and Markets Authority, the CMA, into the acquisition and supply of investment consulting and fiduciary management services. My name's Paul Wharton and I'm a director in the fiduciary management team at Russell Investments, and I'm delighted to be joined by my colleague Sarah Leslie, who's also a director in the fiduciary management team at Russell Investments. We're going to consider the outcomes from the CMA review as they specifically relate to fiduciary management today, and also consider how they might lead to improvements in both transparency and governance for investors.
Thanks, Paul. So today's agenda is going to focus on the CMA review of investment consultants and fiduciary managers, and really what that means for your scheme and you as trustees. It's really important for us to understand why this review is so pertinent to the market. Speaking to other providers of fiduciary management and investment consulting, I think there's very much an understanding of those who take part in the market of why this will be such an important change for governance and transparency. However, many trustees, I think, don't fully understand the magnitude of potential change this could bring about. To best put it, I'm going to refer to the words written by HMRC, the Department of Work and Pensions, and the Pensions Regulator in their letter to the CMA on the 12th of March this year. They note the substantial influence that investment consultants and fiduciary managers can have on the outcomes of pension schemes, noting that up to 50% of households in the UK can be affected by the recommendations made by these providers. Ultimately, the focus on value for money, improving governance, and gaining greater transparency is something that these three bodies are working towards, and the CMA review will continue to enhance these benefits for trustees. Moving on to our first slide of today, this focuses on the CMA's review and some of the findings that they had. But before we get into the detail, I think it's worthwhile taking a brief step back. In 2015, the Financial Conduct Authority, the FCA, carried out an asset management study. As part of that review, which took them 2 years, they referred the investment consultants and fiduciary managers to the CMA with primarily a reason of concern around conflicts of interest. Now, those conflicts of interest were mainly driven by the investment consulting providers who also had fiduciary management businesses, and the recommendation to clients of the investment consulting business to move across to fiduciary management. This was something that the FCA felt was not following a transparent process or good governance, and therefore might be leading to substandard outcomes. And this can be seen as part of the results the CMA have gathered when they reached out to the 17 providers of fiduciary management in the market. 50% of schemes who have appointed fiduciary managers have appointed their incumbent investment consultant. Now, that in itself is not a significant problem. It's only natural that if you work with a provider very closely, particularly over a number of years, that you build up a rapport and you are likely to want to continue to work with them going forward. However, the challenge here is, was the decision an informed decision, and does it result in the best outcomes for the scheme and ultimately for the members? And this is really what can be seen on the other 4 comments on the slide. The first, noting that only 1/3 of schemes went out to formal tender, considering other options in the market. That backed up some of the concerns that the FCA had when they referred investment consultants and fiduciary managers to the CMA. As part of those 1/3 who went through the formal tender process, a number of those were also rubber-stamped processes where the client had selected their incumbent investment consultant and went out to a third party to approve that that was an appropriate course of action to appoint them as their fiduciary manager. Therefore, the actual number of people who went out to full market was significantly less than 1/3. So why does this matter? Well, in terms of getting the best outcomes, the concerns raised can be seen on the 3 comments on the right-hand side. Ultimately, with incentivisations being provided by investment consultants to convert their clients across to fiduciary clients, this meant that it might not be the right choice for the client in particular. The fact that investment consultants have no proven track record in delivering value from selecting asset managers is another cause for concern over performance and outcomes. And finally, noting that those who didn't go out to formal tender were often paying significantly higher fees to their fiduciary provider than those who had gone through a formal exercise. The number there that the CMA quotes is a 24% increase in fees for those who didn't go through that exercise.
For those of you interested in the detail, and you'll certainly need plenty of time on your hands, but the CMA website documents the entire review that took place predominantly over 2018. It includes the working papers and consultation papers, plus responses from the fiduciary management providers, including ourselves at Russell Investments. It also includes transcripts of conference calls and face-to-face hearings with the CMA. So a really comprehensive website that documents the entire review.
So having considered the findings of the review, the CMA then looked into what can we do in order to address some of these concerns. They came out with 8 remedies, of which we're going to focus on 4 today, which are the ones that in particular pertain to the fiduciary management industry. The first one of those is with regards to mandatory tendering and the importance here of any scheme who wishes to appoint a fiduciary manager or has already appointed a fiduciary manager going to formal tender for assets above 20% of the scheme's total assets. This includes, therefore, where you're working with providers to address challenges in alternatives or less liquid markets that might not address the whole of your scheme's assets, but would certainly encompass more than 20% allocation. And it's worth noting here that the CMA's definition of fiduciary management is where the provider is helping the trustees and making decisions on your behalf in asset allocation or manager selection or any other form of service. The second 2 points that are raised on the slide in the bottom left and the top right relate to fees. And this is about transparency of fees for those going into fiduciary management, but also those that are already using a fiduciary manager. On the bottom left, for those using a fiduciary manager, it's important they understand what fees are being paid to the fiduciary manager and what fees are being paid to other third-party providers, asset managers, custodians or others. Whilst we welcome this transparency, I think it's also very important that trustees make sure they ask questions regarding relationships between the fiduciary managers and third-party providers. There are concerns by some in the market that fiduciary managers have relationships with third parties and therefore are using them as preferred providers in order to increase their margin. The second point on fees for those clients going in is about considering any entrance fees, exit fees, or fees for exiting early in terms of penalty clauses. And again, we welcome this transparency as being aware upfront before you go into any relationship of any costs of exiting. However, it's also really important to understand timescales for exit, particularly if you're investing in the areas we talked about before, such as alternatives and illiquids. The cost may not seem overly prohibitive for exiting, but if the timescale is multiple years, it may mean you end up being tied to a provider that you don't want to be tied to for a period longer than you expect. The final point raised on the slide is about performance standards and about performance transparency. This is something that has been worked upon significantly and is about enabling trustees to compare fiduciary managers in a like-for-like way. Historically, there's been the challenge of representing performance data in a consistent way and also avoiding the cherry picking of performance of particular clients that have either done well or have particular characteristics which a fiduciary manager may want to display. Allowing trustees to see on a like-for-like basis as far as possible, recognising that all schemes are different, enables you to make comparisons between providers both prior to investing with a fiduciary manager and also throughout your relationship with your fiduciary manager. Each of these 4 remedies allows you as trustees to gain greater transparency and improve your governance process as part of going through the appointment, and working alongside a fiduciary manager.
Since their initial involvement back in late 2017, the CMA have worked at some pace in terms of delivering their recommendations and the various stages of their review. This culminated in the final report being produced in December 2018, a whopping 440 pages, which really focused on 8 main draft remedies. Ultimately, these remedies will be put in what's called an order. And in February 2019, a draft order was produced, and the CMA invited representations from the marketplace for a period of 30 days from that initial production of the draft order. That 30-day window is now closed, and we are awaiting the CMA to consider the representations that have been made and then issue their final order, which is expected towards the middle of 2019. This final order will implement the remedies, most of which come into effect 6 months later, so from the end of 2019. In addition to those 8 remedies, there are 2 key proposals that it's also worth just dwelling on for a couple of minutes. Firstly, the CMA has proposed that the pensions regulator take responsibility for the new duties placed upon trustees. And I'm pleased to say the Department of Work and Pensions have accepted this recommendation, and therefore it will be forthcoming in due course. Secondly, it's been recommended that the Financial Conduct Authority, the FCA, extend its perimeter to also include the activities of investment consultants. Her Majesty's Treasury have received the recommendation, and their statement suggests that they are considering and consulting on it, so we will await the outcome of those steps over the coming weeks and months. Let's take a slightly closer look at the 4 key remedies that relate to fiduciary management. Firstly, the most high-profile remedy is that requiring new fiduciary management mandates to go through a tender exercise. Now, the actual structure of that tender exercise is yet to be formalised. It's with the pensions regulator to provide guidance later in 2019. What we do know at this stage is that the choice between an open or closed market tender is down to trustee groups, and also that the tender exercise must include at least 3 market participants. Now, this is clearly a step forward from the world we have been living in, where, as Sarah referred to earlier, something like 50% of existing fiduciary management mandates were put in place without any kind of tender exercise whatsoever. So clearly a step forward in governance. Aligned to this, any existing fiduciary management mandate that didn't go through a tender exercise at outset is required to do so within 5 years of initial appointment, although there is a 2-year grace period from the start of the order being in place. Now, we expect third-party evaluators to be made better use of going forward, and actually our experience over 2019 to date is that there's an uptick in the number of retenders going through and the number of new tenders, and also the use of third-party evaluators. The second component of remedies that I'm going to focus on are those relating to fees, both for prospective clients and for existing fiduciary management clients. Firstly, in terms of prospective clients, as part of the tender, fiduciary managers are required to break out their fees in a standardised way. Firstly, the fee level going to the fiduciary manager. Secondly, the fees going to the underlying investment managers, and that also includes a breakout of execution costs. And then the third component are what's called other costs. Now, these have always been there when investments have been made, but these now need to be made explicitly or set out explicitly. They include charges such as the charge for custodians or administration. In addition to these ongoing costs, the CMA has stipulated that any one-off costs as part of the onboarding process should also be estimated. These might include transition costs, costs for initial advice, or legal costs. And then finally, estimates of exiting the arrangement in the years to come also need to be made to ensure that any fiduciary management users know how much it might cost to get out of the arrangement at a future point in time.
A lot of these cost transparencies are aligned with the MiFID II regulation that we've seen come into force earlier last year. And really, that enables trustees and other stakeholders to make comparisons as to the expected costs, the actual costs, and to understand how that might vary between providers.
And the ongoing costs need to be provided at least every year, if not more frequently, and all of these costs need to be provided in both pound terms and percentage terms. The final remedy I want to dwell on here is that of performance standards. And the CMA has tasked the FM providers with coming up with a standardised performance methodology. This needs to be agreed upon within 6 months of the final order, and it needs to be supported by the majority of fiduciary management providers, plus representatives of pension schemes. So that includes third-party evaluators and also professional trustees. If this is not forthcoming within the first 6 months after the initial order, then the CMA will appoint an independent party to come up with a standardised performance methodology, and the cost of that work will be passed down to the fiduciary management providers. Now, I'm pleased to say that over the last 18 or 24 months, there has been a project underway led by a group called IC Select, who have been working across the group of fiduciary management providers to develop a performance standard. And as a group, we're confident that this will be satisfactory and will be put in place within the 6-month time frame. Now, as well as having the remedies, it's clearly important to ensure that they're complied with. And the CMA have also put forward compliance requirements to ensure that both trustees and fiduciary management providers are undertaking their roles in line with the new remedies, and compliance statements and certificates will have to be provided periodically to confirm this. So we've talked through the remedies and what these mean for fiduciary management providers, but what's most important here is that we see some sort of benefit to trustees and ultimately to the underlying members. And let's focus briefly on the benefit they'll see in terms of governance and increased transparency. Firstly, as Sarah outlined earlier, by going through a tender exercise, experience suggests that costs will be something like 24% less than they would be otherwise. Even if this exercise uses the services of a third-party evaluator, which of course come at a cost, we think over the medium to long term, in the vast majority of cases, ultimately a tender exercise will lead to fiduciary management users seeing a cost benefit, and this can clearly be passed directly down to members and the security of their benefits. In addition, across the universe of something like 15 different fiduciary management providers, there are different skill sets, different characteristics, different approaches, different heritages. All of these lead to a range of subtly different approaches to fiduciary management. We think it's right for clients and prospective users to consider what they're trying to get from a fiduciary management arrangement and marry their objectives with what fiduciary managers can offer. By going through some sort of tender exercise, this allows better comparison, better understanding of information and differences between providers, and ultimately should lead to a better alignment between what trustees are seeking to achieve and the fiduciary manager that is ultimately selected.
Thank you, Paul. So, in summary, firstly, we've talked about the background to the CMA review, where it began with the FCA asset management study and the draft order that has been issued earlier this year and the consultations that remain ongoing. Ultimately, we expect legislation to continue to be drafted through this year and into early next year. The remedies that are being put forward aim to increase governance and transparency for all pension schemes and ultimately, therefore, benefit the members. Through better performance and lower costs, better alignment with your fiduciary, you can see that there will be better outcomes for all of the members of the pension schemes. We'd like to thank you very much for your time today, and we'd like to open up the floor for any questions.